Go back through your trading history, look at your biggest loss, your absolute worst trades. I'll bet you anything, most of them have one thing in common. You were fighting the trend. I'm Oli Hochberg, 30 years trading, and I'm going to tell you something that might sound very simple, but it took me years to actually internalize. The trend is your friend. You've heard it before, it's a cliche, but here's what most traders don't understand. Your best trades go in your favor almost immediately. Your worst trades never do. And that's because your best trades are with the trend. Your worst trades are fighting it. Today, I'm going to break down exactly what trading with the trend means. How to define it, how to structure rules around it, and how to stop fighting it. This isn't theory, this is how you survive this game. Let's get into it. Let me tell you something most traders won't admit. They fight the trend because they think they're smarter than the market. They see a stock that's gone 20, 50, or even 100%, and they think that's too much. It has to come down. So they short it, and it keeps on going up. They add to their short, and it keeps on going up, and they blow up their account. Or the opposite, stock is dropping, they think oversold, it has to bounce, so they buy, and it keeps on dropping, and they average down, and it keeps dropping, and then they're stuck. I've done it. Every trader's done it, and it's how you lose money. Early in my career, I had decent trades, I had some big wins, but I kept having these massive losses that wiped out weeks of profit. And when I finally sat down and analyzed every single one of those big losses, 80 to 90% of the time, they all had one thing in common. I was fighting the trend. And here's what I learned. My best trades went in my favor almost immediately. My worst trades never did. Why? Because my best trades were with the trend. The market was already moving in that direction. I had momentum on my side. The worst trade, I was fighting the market. I was hoping for a reversal, hoping momentum would shift, and it wouldn't. So I made a decision. I was going to structure every single trade to be with the trend. Even my mean reversion trades, even my counter trend trades. Everything was going to be structured so I wasn't fighting the market. So first, we need to define what a trend actually is, because if you can't define it, then you can't trade it. The simplest definition, a stock is trending up if it's making higher highs and higher lows. Trending down if it's making lower highs and lower lows. Look at this chart. Each leg up followed by a pullback that doesn't break the prior low. That's an uptrend. Each leg creates a higher low. Each bounce creates a higher high. That's the pattern you want to see. But there are other ways to define trend, and you need multiple definitions because different time frames and different setups require different tools. 1. Holding above VWAP. If a stock is consistently staying above VWAP throughout the day, that's an intraday uptrend. 2. Holding above a moving average. Could be the 20, the 50, the 200 day. Depends on what your time frame is, but if it's staying above that, that's a trend. 3. Holding a trend line. You can draw trend lines connecting the lows on an uptrend or the highs on the downtrend. As long as the price respects that line, the trend is intact. I personally do not use these sort of trend lines very often, but I know some of my trading buddies do. 4. Breaking prior bar highs or lows. This is more micro. If each bar is breaking the high of the prior bar, you're in an uptrend. If each bar is breaking the low of the prior bar, you're in a downtrend. Now here's the key. You need to define trend for your time frame and your style. If you're a day trader, you care about VWAP and prior bar highs and lows. If you're a swing trader, you care more about moving averages and trend line and higher highs, higher lows. And if you're a position trader, you care more about weekly and monthly trends. But whatever your favorite time frame, you need a clear definition because that's how you build your rules. So, once you define a trend, you can build rules, and rules are what save you from yourself. Here are the rules that I use. You can adapt them to your style, but these are non-negotiable for me. Rule number 1, I will never be long if a stock is steadily holding below VWAP, unless it capitulates. What does that mean? If a stock is grinding lower all day, staying below VWAP, I'm not going to buy it. I don't care if it looks cheap. I don't care if it's oversold. The only exception is if it capitulates. Massive volume, huge dump into previous support area, and then a clear reversal. That's different. But if it's just grinding lower, I'm not touching it. Vice versa for shorts. I'll never be shorting if a stock is steadily holding above VWAP, unless it capitulates. Rule number 2, I will not trend range-bound or consolidating stocks. If a stock is chopping around in a range, I'm not interested. I'm not trying to scalp pennies. I'm waiting for the breakout confirmation, waiting for the trend signal to start. Range-bound stocks are where traders die by 1,000 cuts. They take 10 small losses trying to catch the breakout before it actually happens. So, better to wait for the trend, then you trade it. Rule number 3, I size bigger when trends align across multiple time frames. This is huge. If the daily trend is up, if the intraday trend is up, and the weekly trend is up, I'm loading up. Why? Because now you have day traders, swing traders, and position traders all on your side. Everybody is buying. That's usually when you get that sort of monster move. Rule number 4, if a trade doesn't go in my favor almost immediately, I'm questioning it. This doesn't mean I will exit immediately, but if I'm underwater for more than a few bars, I'm asking myself, am I fighting the trend? Because remember, the best trades go in your favor almost from the start. If they don't, you might be wrong about the trend. Now, you might be thinking, Oli, what about mean reversion? What about buying dips? Great question. And here's the key. You can trade counter trend, but you still structure it to be within the trend. This is what I call the right side of the V. The stock dumps, it capitulates, and then it turns. You don't buy on the left side when it's still going down. You wait for the turn. You wait for confirmation. Maybe it breaks the prior buy high. Maybe it breaks the downtrend line. Maybe it reclaims VWAP or a moving average. Whatever your signal is, you wait for it. Once you get that signal, now you're with the trend. The trend has reversed. You're not fighting it anymore. This is the mental shift most traders miss. They think counter trend means fighting the trend. No, not necessarily. Counter trend means waiting for the trend to change, then trading with a new trend. That's completely different from buying on the left side of the V and hoping it might turn. I used to take massive hit on mean reversion trades. I'd buy a stock that was dropping and I'd watch it drop another 10, 20%. I'd be underwater for days. Once I started waiting for the turn, for confirmation that the trend has reversed, I stopped taking hit. My win rate went up, my stress level went down, and my P&L went up. So yes, you can trade reversals, but structure them so you're within the trend, not fighting it. So here's what we covered. 1, your biggest loss comes from fighting the trend. Your best trades go in your favor immediately because they are with the trend. 2, define the trend for your time frame. Higher highs and higher lows, VWAP, moving averages, trend lines, break of prior highs or lows. Pick what works best for you. 3, build rules around the trend. Don't long below VWAP unless it capitulates. Avoid trading range-bound stocks. Size bigger when trend aligned across time frames. 4, even counter-trend trades should be structured within the trend. Wait for the turn, wait for the confirmation, then trade with the new trend. Look, I know it's tempting to think that you're smarter than the market, and I know it's tempting to try to catch the exact bottom or the exact top. But that's not how you make money long term. That's how you blow up your account. The traders who survive are the ones who respect the trend, who don't fight it, who wait for it to change before they bet against it. So the trend is your friend, not because it's a cute saying, but because it's the only way to survive. Stop fighting it, start trading with it, and watch your P&L and your trading stats change. I'll see you in the next one.